if you're looking at folks that are looking at either the buy side or the sell side, what are some of your best pieces of advice for them on, here's how to think about and have a really successful experience with your deal?
Yeah, Sam, I loved what you said about know what you want.
Mm,
Know what you want, not just from a money perspective and what you need to walk away with, but know what's important to you. And that sounds like a simple thing, but that takes time to really think through. And so I think knowing what you want, and I also liked what you said about using advisors that you trust, that you like, that understand you and that know you, because they can help you talk through, well, wait a minute, I thought you said you wanted this. What you're talking about now isn't going to get you this thing. Are you sure that's what you want? And kind of help you with the logic, because I think what people are surprised by with this process when they go to sell their business is the emotions involved.
Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman.
Well, welcome back, everybody, to the How to Buy and Sell a Business Successfully. I'm with my amazing co-host, Sam Foreman, today. My name is Jake Wayman, and my wife and I are the Orange Theory Fitness franchisees here in the Wichita area. And I also am a fractional business development executive for my firm, Wayman Consulting Group. And I will not forget to talk about my kids this time because I have three amazing kiddos. I have a 9-year-old, a 3-year-old, and a 1-year-old. And we actually just went through ISR lessons with my kids. For those if you're not familiar with those, there's for like infant save rescue, whatever that stands for. But that was an interesting ride. They actually all went in their clothes yesterday, and it's fun to see them be able to do that. So that's what our summer has been like so far, that in sports. And so, but yeah, I'm joined today with the awesome co-host, Sam Foreman. Sam, you want to introduce yourself?
Yeah, I do. Jacob, thanks for being here. And thank you to our listeners for joining us today. My name is Sam Foreman. I'm an M&A attorney, and I work with a lot of businesses on a variety of business matters as well. But my favorite role in life is being a dad. Right now, I have a 6-year-old and I have a 2-year-old. And our 6-year-old is autistic. And one of the things that I really enjoy about being his dad during this phase of life is just getting to really engage with him and how he sees the world in a different way than I do, which has been really challenging for me, but also really rewarding because it's really changed my view and my perception on people with autism, just to kind of see how he functions in life. And he's such a kind boy. He's always doing really kind things for his younger brother, who frequently, I would say almost uniformly, does not appreciate how kind and thoughtful he is being.
He will one day. One day he will.
He will. And in the meantime, it's both frustrating and entertaining. I frequently find myself having that parental moment where I'm yelling at my kids to stop yelling at each other. That's just that's a terrible feeling as a parent, of like, I'm yelling at my kids because they're yelling at me or yelling at each other. Like, oh, okay, I got to work on this. But no, I love being a dad. It's awesome. And today we're really grateful to be joined by a phenomenal tax accountant, Stacie Wilson. She's with Swindoll, Janzen, Hawk, and Loyd. Your firm doesn't just serve kind of the Hutchinson area, which is where you're located. You have an office here in Wichita. You're really serving people around the state of Kansas. I think Manhattan, Salina, McPherson, but really, kind of leveraging that larger scale to be able to provide really high quality services to your local clients in a way that helps them really achieve their objectives and really get access to really high quality of services in the process. And we were just talking about a program earlier that I'd like to talk about in a minute, your First 15 program. But before we do that, why don't you tell our guests more about yourself?
Yeah, thanks, Sam. Like Sam said, I'm Stacie Wilson. I'm a CPA partner with Swindoll, Janzen, Hawk, and Loyd. I've been here, probably close to 15 years total in the public accounting space. My world is mostly tax and advisory for small and medium-sized organizations and their owners. I'm also a CVA, a certified valuation analyst, and so I get involved in valuing businesses and consulting with them on what their business is worth and just the exact topics that we're going to be covering today. From a personal perspective, my husband and I, we have 4 boys. And so I can relate to you, Jacob, on the busy summer. Seems like it's just flying by. But we, have sports and all sorts of different things going on this summers, but it's been fun.
No, that's terrific. Before we dive into tax topics, and I think this will have a lot of relevance for our listeners, you all have a really interesting program at your firm called First 15. Tell us a little bit about that.
Yeah, so First 15 was developed by our managing partner, Chet Bookman. I don't even know how many years ago, probably before I was back with them. But what it is we encourage each of our team members to spend the first 15 minutes of their day reading a book. Not a fiction book, but something in the world of business or personal development or anything in that space. And what we have found is that it has really set a tone for our culture. I'm not even sure we can measure the true impact of it. But it just sets a good tone for the day. If you think about, you're yelling at your kids in the morning to, get ready for school or whatever, and then you get to work and you're just kind of frazzled. Well, it gives you a chance to center yourself and get focused on what you need to do for the day. And I also think, it's helped our team develop leadership skills and other interpersonal skills that sending them to a seminar maybe wouldn't have the same impact.
Yes, that daily intention is powerful. I mean, that's something that I try to do every morning is journal, and having that time that you focus on that's great. I love that. That's a cool for your culture at your company.
Yeah, it's really interesting to hear you talk about the impact that program has had over time. When it's really it's a lot of the accumulation of those really small steps along the way, just that 15 minutes a day, and that consistency over time. And I think that there's a lot of parallels, I think, for that with the mindset that I think successful business owners bring to the table. Is it's not, hey, there's this big conference we've gone to train our people. It's this big program. It's, hey, we have this culture that prioritizes learning, that puts it first in the day, that takes those sharpest moments that somebody might be bringing into the day, and makes that a kind of a core expectation. And actually empowers people to go do that. And I think that's phenomenal. And I think there's a lot of parallels to kind of preparing folks for a successful exit if they're going to sell their business. Is think about what are those smaller things that they're doing along the way that really help them prepare for it. When you work with clients on kind of the tax side of things as they're preparing for a sale, do you see folks that come in who haven't been taking those diligent steps along the way and they've just kind of realized, hey, I need to get my house in order? Or is it more frequently like folks that have been diligent and they've got everything in order and they're ready to go, or kind of all of the above?
Yeah, really all of the above. I would like to say that if it was an existing client of ours, we would know, a few years in advance that they were getting ready to sell, and we'd be helping them to get to that point. And I think we do a pretty good job of that. Sometimes, things happen and all of a sudden an opportunity comes along or something changes in their life and they need to move a little faster than what we would like to get them ready. But again, if they're an existing client, we're usually working with them, for the 5 to 7 years prior to sale on getting them ready. However, we have had a lot of people come to us and they're not an existing client and they'll say, I'm getting ready to sell, what's my business worth or how do I go about doing this? And those can be kind of tricky. If their financials aren't in good shape, we want to get them to a point where they are in good shape, because an astute buyer would notice those things and that would raise a red flag and potentially kill their deal. So we've had a few of those. In fact, recently one of my partners had a deal that she was working on with a new client. They came in, their books were kind of a mess, and we worked really, really hard to get them cleaned up, and they were actually able to sell for about 15 million. And had they not, got those cleaned up, they may not have gotten a deal at all. And then occasionally we have the people who come to us and say they're already working on a deal, and they kind of bring us in last minute, and that's never good.
Yeah.
So
Well,
all the above.
Well, and something we've had as a common theme in a lot of our conversations we've had is around, organization and preparation, those sort of things. And when you say books are a mess, like, we'll kind of elaborate a little bit on what do you mean by, well, their books are a mess, and like, because so me as a business owner, I want to actually kind of want to ensure my books aren't a mess. So
Yeah, and so as accountants, we're pretty decent at spotting things that just don't make sense on a financial statement, right? But you kind of look through the balance sheet, and if you can usually verify the balances on the balance sheet if they look reasonable or not. If the bank accounts haven't been reconciled for years, that's obviously a problem. If the debt isn't on there or isn't correct, that's pretty easy to identify and get that cleaned up. But you're looking at consistency of reporting. You're looking at a lot of different things. Hopefully that you've been working with a CPA that knows what they're doing and keeps those clean for you, but not everyone is.
yeah.
What do you see happen to folks that go into a deal and they don't have that consistency? So, for example, they have several years in a row where they've been treating things differently. There's big changes in accounting method, whatever that is. How does that impact, like, the buyer's perspective, for example?
Yeah, great question. We just had a deal recently where we were going through the due diligence process. We were helping the seller. We'd gotten quite a ways through the due diligence process, and they discovered that there was some inconsistencies in how they were valuing their inventory. And this is a manufacturer, so inventory is a big deal for
Yeah.
them. And it's not so much, the number. We could say, well, the number should have been this. But when they're seeing that there's inconsistent treatment going on, and the numbers aren't making sense, it just scared them. And they didn't have a lot of faith in those numbers, so they walked away. So now we're in the process of working with them to get a process that will give them a consistently accurate number for that inventory valuation, so that we can go back to market and get them a good price.
Yeah, no, that's they're lucky to have you on their team. But that's a really sobering story for a lot of folks, because some people aren't going to have the luxury of being able to go back through the deal process and take a second crack at it. We see this happen all the time where a business owner has held on too long. They've made the business so much a part of their life that they just can't let it go. And then sometimes they die, and then that's where the business is going to go be sold, or it's just atrophied so much because their friends that their clients or their suppliers have retired or moved on or whatever, and now those relationships are starting to peel away. And then they try to go through a process and they can't, because they don't have enough value to transfer. And then as a result, they end up just having to close it and sell it off for parts. I mean, that's just not a great position to be in. What we talk to folks a lot about is, the sale price you can command is all about the amount of value you can transfer to the buyer. And because that's a deal's an exchange. If you want a big piece coming your way, you got to have a big piece going to the other direction. And if you don't have the ability to substantiate that what you have is a big piece of value, then what do you have? Right. And I think that a lot of folks are starting to kind of understand that better as they get closer to having an intentional sales process. At least I certainly hope they are. But when you look at kind of the critical role that tax advisors play in the deal and the financial team, there's a process that happens in a lot of deals called quality of earnings, and being able to go through that process. For some folks that's going to be a new term. from your perspective and your involvement in a process like that, can you explain that to our listeners?
Yeah. So in my mind, quality of earnings is really about just like you said, if I've got a set of financials before me, are those numbers right? Are they accurate? Are they reasonable? And can they be supported long term? If it's a company that's highly dependent upon contracts and those contracts are ending, what kind of impact does that have on earnings going forward? If you've got a key player in the organization that's getting ready to retire, or or just they're dependent on that person, and there's a little bit of risk there. And so just looking at those the factors that are feeding into their earnings, their revenue, that's really what you're looking at. And so it varies by industry, what's really impacting it, but you just want to make sure that what has happened in the past is reasonably likely to continue going forward.
Mm-hmm. No, I think that's such a great way of describing it. Your numbers tell the story about your business.
Mm-hmm.
It's what helps the buyer who doesn't know your business, doesn't know what that looks like, be able to understand that, hey, what I'm being told about what this is actually lines up with these. And when they can't rely on your numbers, it tells them something different about the value that you're trying to transfer to them. It makes it so much less reliable, so much more unpredictable. And then when they're thinking about like, hey, here's what I'm willing to exchange for that, they've got to control for that risk. And if you're on the buy side and somebody's telling you a story about how beautiful and wonderful their business is, you need to be able to back that up through your due diligence process, through your quality of earnings, and be able to look at it and be like, yeah, that makes sense because I can see that this is here. But, when you're looking at like the buy side, for example, and you look at companies that have, your clients that have bought businesses and, when they buy a business that has messy financials, what does that transition process look like for them?
So one good example we've had recently, we had somebody purchase a business, and I think it must have been a stock purchase, or this probably wouldn't have been an issue, but
Sure.
they got into it and realized that the seller hadn't filed tax returns for a few years. And so, yes, you can get caught up. Yes, there's a way out of it, but you don't know what you're getting into in that case,
Yeah.
So yeah, as a buyer, you want to be coming in and making sure that you've done your due diligence process.
Yeah.
They've filed their tax returns, their financials are good, because you don't know necessarily what you're walking into.
Mm-hmm. No, that's really important. And if you find a seller that has not filed tax returns,
run away
for several. Well, not necessarily run away. That could be a really good opportunity for a bargain buy.
That's true. That's true. True statement.
But when you see those red flags as a buyer and you see those kind of things, when you see messy financials, when you see people not filing tax returns, that should tell you about how careful they've been with the whole business.
Yeah.
And if they're that lax with or inattentive to detail with their regulatory obligations, with their financials, what does that tell you about the level of service that they've been providing? I mean, sometimes nothing. I mean, sometimes their level of service is world class and it's just they hate, attending to those details. But I think my observation is that frequently you see the same sort of character throughout the business. If they're not attentive to detail over here, they're generally not attentive to detail over there. Has that kind of been your experience as well with your clients?
Yeah, absolutely. And what it's really about is just building confidence, right? Everybody makes mistakes, and you can find errors in probably any set of financial statements, but if you come across thing after thing after thing that hasn't been done correctly, you just lose confidence. And then once you have no confidence in their numbers at all, you don't know what the value is, or how to go about structuring it. And so a lot of people walk away at that point.
What is it about that kind of coming to that realization that makes people walk away?
I think it's just, again, lack of confidence. If you want to know what you're getting into, and there's always a risk assessment there, right? Because your price is based on your risk assessment and your rate of return that you need to get from your investment. And if you can't feel reasonably confident that you understand the risks,
Right.
it makes it hard to go into it with yeah.
Because you're asking the buyer, if you're the seller, you're asking the buyer to exchange value with you. And, if I'm the buyer and I'm looking at that, I'm like, what is the value? I mean, I can't answer that question. And I'm going to go put a lot of my money if I'm an individual and I'm buying my first business, for example. I mean, is that really the risk that I want to take? Do I want to put my family's livelihood on it? If I'm going to go the SBA financing route, I'm going to put a mortgage on my house. Do I really want to put my life on the line, my family's well-being on the line because of your messy financials? Or at least at the price that you'd like to get as a seller. But there's hope. Or I should say, where there's time, there's hope.
Yes.
If somebody's looking at like, hey, I mean, I really need to look at selling a business, and I'm looking at my books and I'm going, okay, the bookkeeper that I've been hiring for this forever, I'm just not sure that they've done the job that I need to be able to present this really well to a buyer. How much lead time is really helpful for a firm like yours to be able to, get to know those folks, understand their priorities, and then really help them understand and then execute on the value that like cleaning up their books can really do from a sales prep perspective?
Yeah. So cleaning up their financials is one thing, and that's a relatively short time period. But if we're going to help them get ready to sell, we want to be working with them at least 5 years ahead of time. And part of the reason for that is not necessarily because they have messy financials that need to be cleaned up, but we all know that as a business owner, you tend to run things through your business that are maybe a little gray area because you want the tax deduction. Well, what that does is it drives down your earnings on your financials.
Right.
If you're getting ready to sell, you want it to look better. And so working through some of those things to just improve the way your financials look takes a little bit of time, even if they've always been clean. And there's also some tax planning that needs to happen in the years coming up to the sale of your business. What kind of deductions you even want to take in those last few years, not just the tax implications of the sale, but how aggressive do you want to be on depreciation? If you're going to end up selling in a couple of years, it probably doesn't make sense to be aggressive on depreciation. And so we can kind of help people maximize their, call it the overall cash flow from their business if we have, at least 5 years of lead time to get them there.
And then kind of looking at like structures of businesses like C Corp versus LLC versus S Corp, what's when a seller is looking to, get their organization ready to sell? I mean, what is there a better structure than another? I mean, is it worth changing structures if you're looking 5 years in advance? What's some suggestions on that from a tax perspective?
Yeah, I don't really want to say for sure yes or no because everything depends on the situation, right?
Good answer.
Yeah, you and attorneys and accountants, always depends.
Well, we should rename the podcast. It depends. Yeah.
That would be amazing. And of course, I don't want to tell somebody, if you have an LLC, you want to switch it to a C Corp, that because it depends on their situation. But I think that's another great reason to be getting advice a few years in advance, because there may be, depending on the situation, an opportunity to get a better tax impact if they do switch. I can't think of any examples where I have switched an entity structure prior to sale, but that's not to say that it wouldn't be advantageous to someone.
Sure. Yeah. What are some examples of some things that if somebody has enough time to plan in advance that they could do that could improve their tax readiness for a deal?
Well, so I mentioned earlier about, if you're a capital intensive business, you're buying lots of fixed assets, you're probably going to maybe change how you're depreciating those if you're buying them just a few years prior to, some non-tax things though that you might be looking at is, do you have your pricing right on your product or service, whatever that is? We've seen in the last few years, we've just seen prices skyrocketing in some places. And quite honestly, some people haven't kept up with that, and they could. So helping them get their pricing set appropriately that could be sustainable going forward will help the bottom line as well as the overall sale price. I think again, just looking through, if you're being a little overly aggressive on some of your deductions, you might want to back off on some of that coming up to sale. You're going to pay a little more tax in those 4 or 5 years going up to it, but that could mean a lot more in overall sale price when you do get ready to sell. And then some of the things that you just need to be aware of, you mentioned your structure. Sometimes your structure can have an impact on the taxability of your sale. So you want to be aware what that is and how that impacts it. You also want to be looking at, Sam, I think you mentioned the cash flow. Your sale price isn't everything. You want to be looking at the overall cash flow of it. And so that includes, paying off your debt and the taxes.
Yeah.
Some people think that, if they've got a lot of debt, that will reduce their taxes, and that's not the case. You just want to be aware of what that cash flow is going to look like and if that's going to meet your needs.
Yeah, no, that's really helpful. And I'm glad you brought that up. Because sale price is not what you actually get to keep at the end of the day. It's related, but it's not the same thing. Because like you mentioned, you've got to pay, you got to pay off debt usually as part of the deal. You've got to pay taxes on it. You got to pay, those dadgum attorneys. They're just the worst. And you also get to pay accountants, which is a much more pleasant experience. They actually create legitimate value. But yeah, it's important, I think, for folks as they're planning out that timing and they're figuring out, like, hey, what is that number that I need? If it's a need-based number and it's a need-based sale, or they've got a minimum threshold that they've got to meet, and just having that conversation with somebody like you early on to say, like, hey, let's sit down, let's look at my financials, let's figure out what a reasonable purchase price might be, and walk me through what am I actually going to walk away with. Do you find that folks are prepared for that discussion, or that you kind of have to help guide them to it?
As far as the value of their company, I see a wide range of responses when we start talking about the value of their organization. Some people have a pretty realistic idea of what the value is. Others, maybe they think it's worth a lot more. And you have to kind of walk them through that and why their organization isn't worth quite as much as they think it is. And sometimes, we surprise people. We say, really, I think you could get X, and they're maybe half of that number, or thought that they were half of that number.
Right.
So, no, I think that's probably one of the best conversations that we have is walking people through, the what drives that sale price, as well as the things that they need to consider when they're looking at the net cash flow from the deal.
Yeah, no, that's really helpful. When somebody comes to you and says, hey, I know this is all going to be taxed at capital gains rates. For those that are listening, she's got a great smile on her face that tells me she already knows where I'm going on this. Like, what is your reaction to that?
Well, you brought up earlier, the sale price is not the end, right? There's probably even more important than the sale price is the terms of it,
Yeah.
And so you're right. Some sales may be all capital gain. It really depends on how it's structured. If the seller's lucky enough to get a stock sale deal where the buyer is just basically going to step in their shoes and continue running the company, most likely that will be capital gain. However, I rarely see a stock sale happen because most buyers are insistent upon what's called an asset purchase. And so in that case, especially if you're a capital intensive business where you've got a lot of equipment, even furniture, possibly a building, you're going to have some what's called depreciation recapture on that when you sell the assets. And those that recapture piece is taxed at ordinary rates rather than capital gains rates. And so you need to be aware of those things. The other thing with the actual terms of the deal, maybe you want to do an installment sale. There's a lot of different factors to consider in that, but it could make sense for a seller to do an installment sale and spread that tax over a period of time. The other thing I've seen a lot of is like a consulting agreement with the seller. So maybe the buyer says, yeah, I'll give you your price, but of that price, I want, $100,000 to be paid out over a period of time. And I want you to be a quote consultant to me. And so the benefit there for the buyer is they can deduct that as an ordinary deduction at ordinary rates. On the seller side, though, they're going to have to pick that up in income at ordinary rates as well. But that's where you negotiate, right? And you figure out what the tax impact of all those things are, and people land where they need to land, hopefully.
Yeah, no, that's helpful. From a buyer perspective, if the seller wants to do an installment sale, does that have any kind of tax impacts that the buyer should be aware of?
Not really, because most of the time that's probably going to be a stock sale. I guess not necessarily. Usually where we're looking at the tax implications of that is on the seller side.
Yeah. No, that's terrific. Every now and then people will ask us questions about hot assets as part of a transaction. Can you help our listeners understand a little bit better what are hot assets, and particularly if you're on the sell side, what sort of things do you need to be thinking about in terms of those tax impacts?
Yeah, good question. So I'll give you an example of a hot asset would be like accounts receivable. So I'll just take us as an example. As an accounting firm, we're not on what's called the accrual basis as a taxpayer. So we're not paying tax on the accounts receivable that we have with our clients. We're on a cash basis. So we don't pay tax until we actually receive that money. However, if we were going to sell, what a buyer would be buying would be our accounts receivable that aren't even really on our books. And so if we're going to be selling those accounts receivable and we've not paid tax on it, we're going to have to pay tax on it at the point we sell at ordinary rates. And so those hot assets, what those are assets that sort of get reclassified from a capital tax impact to an ordinary tax impact.
Sure. So you could have a client that might, correct me if I'm wrong, might have, a sale that's primarily taxed at capital gains rates, but then that has like depreciation recapture, that has hot assets that could make up a substantial portion of the value. And then depending on what the relevant tax rates are, you end up with this sort of blended rate of tax on the deal where you might be thinking, I can't remember what the top rate is now. Is it 20%?
Gains, yep.
Yeah, for capital gains at the federal rate, where you might be going in expecting, well, okay, I'm selling my business for $5 million. I've held it for long enough. It's going to be a 20% tax rate, so I'm going to pay $1 million in taxes. And then when you peel back the layers and look at it, you might be paying more like 27% or 25% or whatever, which is a substantial difference for some folks in terms of how much they're going to walk away from the deal with.
Yeah. And then another thing we didn't really touch on, when you talk about the terms of the deal, you want to look at what's called the purchase price allocation. And that's really what you were getting at just there. So if our total sale price is $10 million, well, how much of that is allocated to equipment? How much is allocated to goodwill? How much is allocated to those, what you're calling hot assets? And that's a negotiating point. Obviously, the seller is going to want less allocated to equipment and hot assets and those things that would be taxed at ordinary rates, and the buyer wants the opposite. So those become negotiating points.
When you look at why the buyer, for example, might want more allocated in a particular direction, what does that do for a buyer that sort of optimizes the allocation prior to the transaction? How does that help them on the back end of the deal?
Yeah, so if I'm buying your business and I'm getting what I want in purchase price allocation, I'm going to have as much as possible going to furniture, equipment, those things that can be depreciated over a shorter life period. That's really what you're after. You want the asset, most of the purchase price going to assets that can be depreciated faster. Currently, I think you get like 60% bonus depreciation on that, or 100% 179 depreciation on those assets, if it makes sense for you. But even if, the equipment is over 7 years and you don't want to take advantage of bonus or 179, it's still much faster than, say, the building at, 39 years.
Yeah, or goodwill at 15. So if you're a buyer and you're looking at, the importance of having a good tax advisor on your team to help you have the right, have an optimal purchase price allocation, think about how many dollars you're actually going to keep in your pocket those first couple of years after closing, because those dollars are going to work and need to work really, really hard for you. The faster that you can reinvest those into your business or use those to pay down debt, or whatever that might be, the more successful you're going to be long-term, versus if there's lots of those dollars that you've got to chase and recover, over a more extended period of time, that can just slow down your growth a little bit. When you look at, folks that get talked into a stock purchase, for example, I say talked into, sometimes it's from a buyer perspective, talked into it. And sometimes it's a great fit for both parties. I mean, do you ever run into people that are surprised by the tax consequences after the deal? I'm sure they won't be surprised if they've talked to you first, but they come to you maybe after they bought the business. And it's like, hey, where's my depreciation? Well,
yeah. So no, it's never happened to me because of course my clients talk to me first, right?
Yeah, that's good.
No, we actually have. Sometimes the CPAs are the last to know, which is unfortunate. But yeah, it has happened where we've had a client work out a deal, come tell us about it, and we're like, well, if you had done it this way,
right,
we could have saved you some money, but not much can be done at that point.
Yeah. No, that's really helpful. I mean, it feels like I see this behavior a lot, that people wait until they've got an LOI worked out before they want to hire professional advisors to help them with it. I know from our perspective on the legal side of things, or I should say my perspective on the legal side of things, that really makes it difficult for me to maximize the value I can create for my client, whether I'm on the buy side or the sell side. Because if somebody comes to me and says, hey, I worked out these 8 points, like they've already got an agreement in place, or at least an agreement in principle in place with the other party. And I can raise something really significant, really important for them that's going to create or save them, hundreds of thousands or millions of dollars, whatever it might be. And in order for them to get that, they now have to go ask somebody to change the deal. And they might have to exchange something for that piece of value that now they're getting, or in some cases, they're going to lose the deal over it. They have to choose between potentially losing the deal over it or keeping the deal that may not have been optimal. Do you find a similar experience, for what you're doing in terms of if people get you involved early enough, how much value you can create versus, after the LOI is already in place?
Again, there's, wide range of experience, but yes, we do want to see all of those documents before they're signed. And I don't know, Sam, I'm assuming you've had a similar experience, but we even kind of like to speak on behalf of our clients sometimes when it's appropriate, because maybe they don't really understand the language and what's being asked.
Sure.
And they may possibly overshare, not that they're trying to hide anything or we want them to hide anything, but that process can just be so emotional that they're oversharing things. And so I think just having us, whether it's CPA, attorney, whoever, help in those conversations can help move things along beneficially for them.
No, that's really helpful. Jake, do you have a question?
No, you guys are doing your accountant attorney thing back and forth, and I'm sitting here as a business owner, just like, oh my gosh, like, I have a lot of work I need to do on my business to if I ever want to sell it. So yeah. But I mean, I think what questions are for me from a business owner perspective are like, what mistakes have you seen buyers or sellers make when going through the deal? Or maybe on the flip side, what are things that they can do to avoid those mistakes? I mean, I know we talked about cleaning up the books, those sort of things. And it's like, how can me as a business owner know that I'm checking my boxes, so when that opportunity does come for me to sell my business, I'm like, no, I'm good. Like, I did the right things as a business owner.
Yeah. And you can never be absolutely sure that you're going in, into a deal with your, that it's going to work out great. But I think, the biggest mistake I've seen is really, we're going to sound like a broken record, but not getting that professional advice before it's too late to change anything.
Right.
I think that's the biggest mistake I've seen. And it's not the end of the world, but we could have helped you get a little bit more, or just make life a little bit easier for you.
You mean I just can't Google it?
No, I'll tell you what I tell a lot of people, and some of my peers will probably lecture me for this. But I think Google honestly is a great place to start. It is a horrible place to finish.
Yeah.
And I think that's where people make the mistake, is they think, oh, I found this. And especially in today's world with the creative AI, make sure you know what you're getting. It's a great place to start educating yourself, to learn a lot of things. But where you want to finish is you want to finish with somebody that has experience and the benefit of professional judgment, and usually the benefit of a relationship with you, to really understand, like, hey, I know you, Jacob, and I know what's important to you, and I know how you value things. And so when you ask a question, when I've got that relationship with somebody, I can usually then understand and be like, hey, I think I hear you asking this question, but I know you well enough to know that I think really the question you might, want to be asking is this one. And when you have a good relationship with a really good provider, they can do that with you and help you really optimize value out of the process.
Yeah.
Because a lot of times it's not as clean cut as, hey, tell me what's going to leave me with the most bucks in my pocket at the end of the day. I mean, a lot of our clients are thinking about, like, hey, what's going to happen to my employees?
Yep.
Right? Like, are they going to still have a job? Or is, some private equity firm going to just kind of lay them all off after closing, terminate the lease, pull out of town, and just go take the client list with them? People want to know what's going to happen. And sometimes that's more important than getting the top price or having the most dollars to take away on stuff. But yeah, I mean, if you have the benefit of that great team around you, I mean, it can make a big difference. I mean, when I'm talking to folks about, early on in the process, I'm trying to understand, are they looking to like minimize cost on the process, or are they looking to maximize value? And it's just a different mindset. Because some folks are looking to, minimize costs in a way that, like, hey, I want to wait as long as I can to, hire a good tax advisor, or I want to wait as long as I can to hire a good lawyer or whatever. And then sometimes they miss out on opportunity as a result of that. But what we always want to encourage folks to do is know what you really want, right? Sometimes managing costs is the best way to maximize value. And sometimes it's not. But when you have a good team that you really trust, they'll tell you honest answers to those questions, and like, hey, I'd run this process as lean as I possibly could. Don't spend any more dollars on me than you absolutely have to. And sometimes it's like, hey, there's enough going on here that I can create a lot of value for you, but you need to get me involved at the right time. And, you need to let me do the things that I'm really, really great at in the process. I'm curious. So every now and then we have somebody talk to us about this really fun, super exciting, great party conversation topic, 338H10. Can you tell?
Is that a drinking game?
Is it? This, you know what? It should be a drinking game. Hey, in the interest of encouraging our listeners to engage in healthy activity, we're going to create a mocktail centric game for the podcast. Every time Sam references some obscure legal or tax term, you're invited to drink your favorite beverage of choice. Yes. Sorry, Stacie. Yeah. What we're actually talking about. I like the drinking game direction though, Jacob. I think that's a good one to go. But Stacie, for our listeners that maybe aren't familiar with the 338H10 election, can you tell us more about what it is and where it might be really helpful for them as they're putting together a deal?
Yeah, that's a great question. So if you remember, it talked about, stock sale versus asset sale, right? So typically, all else equal, a seller wants to do a stock sale, a buyer wants to do an asset purchase or asset sale. There are times when you don't really have a choice. For example, if the business has contracts that are non-transferable, you almost have to sell stock because the buyer can't get those contracts any other way. So you have to do a stock sale. The 338H10 is another one of those, call it negotiating points, where from a legal perspective, it's going to be a stock sale, but we're going to make this election and we both have to do it. And that's why it's a negotiating point, but we're going to treat it as an asset sale, asset purchase. And so that's where the 338H10 comes in, is when you and I as buyer and seller, we agree we'd like to do an asset deal, but there's something else that is, you might say, forcing us to do a stock deal from a legal perspective.
Yeah, no, that's a great explanation of that. And I mean, it all kind of comes back to, if you want to get the most value out of the transaction, whether you're on the buy side or the sell side, you've got to be thinking about how to maximize the value that's exchanged. And if you're looking at the business and the way to maximize value is that it's a stock sale, then you get to think about this other layer of stuff like, hey, is there a tax election that we could make, like a 338H10, that puts us in a position to, create more value out of the transaction? But if you're at the table and you're a buyer, for example, and you're negotiating and you don't have an LOI that says there's going to be a 338H10, and then you get your team involved, that might be something that you then have to pay extra for, that you might, maybe you would have been in a position to get that without having to pay extra for it if it had been part of the initial negotiation. And that's where I think teams can create really great value for people is, understanding really well at the front end, like, hey, what's most important to you? Like, how do you create value on this deal? Based on your own personal or your ownership group's, set of priorities. And then making sure that they take their experience and their knowledge of things to help you position it in an optimal fashion at the front end of the process, because it gets so expensive and it actually adds risk, I think, a lot of times to try to negotiate all that stuff after somebody's already thinks they've got a deal. Because sometimes they make a deal with you where they've got something in their mind and you have something else in yours, and they're not the same thing. And usually really good experience providers like you, Stacie, can help somebody see and understand, like, hey, I think that the reason they agreed to this is because they're misunderstanding this. And I think what we really need to do is we need to make sure that we're all on the same page on this, because before you spend more money on me, before you spend more time on the process, like, let's make sure we've actually got a deal here and that it's the right deal. Because your bargaining position, your bargaining power is usually never greater than when you are most willing to walk away. Like, because as soon as somebody's like, I've got you, like I think you're too committed to the process. You've spent too much time on it. You spent too much money on it. Like, your bargaining position starts to go down because they know that it's getting more and more expensive for you to walk away. But when you give yourself maximum optionality, towards the front end of the process, where it's like, hey, if you don't like this, that's okay. I've still got time and I've still got money to go find somebody that's willing to give me what I'm looking for. That's a different ball game, because now they're competing against another opportunity that's more compelling to you than continuing to go forward with them. But Stacie, you've been so generous with your time with us today and your wisdom for our listeners. Just kind of one last question that we have for you is, if you're looking at folks that are looking at either the buy side or the sell side, what are some of your best pieces of advice for them on, here's how to think about and have a really successful experience with your deal?
Yeah, Sam, I loved what you said about know what you want. Know what you want, not just from a money perspective and what you need to walk away with, but know what's important to you. And that sounds like a simple thing, but that takes time to really think through. And so I think knowing what you want, and I also liked what you said about using advisors that you trust, that you like, that understand you and that know you, because they can help you talk through, well, wait a minute, I thought you said you wanted this. What you're talking about now isn't going to get you this thing. Are you sure that's what you want? And kind of help you with the logic, because I think what people are surprised by with this process when they go to sell their business is the emotions involved in it. It's kind of like, it's almost like a grieving process for some people, if this has been their baby for, years, or they built it from the ground up, or whatever their story might be. I think they're surprised by the amount of emotion that's involved in it. And so having someone that can help you think logically, that cares about you, that can walk you through the process makes a ton of difference.
Yeah, no, that's excellent advice. Excellent advice. Well, thank you so much for joining us today. And to our listeners, thank you so much for tuning in for another riveting episode. We've really enjoyed this conversation. I mean, there's so much power in getting good advice. I mean, it can make a huge difference, and getting it early enough to where people can actually put it to work for them. I mean, it's truly a game changer. I mean, as business owners, we have often this once in a lifetime chance to change the story for our family for generations. And when we really diligently take care of that opportunity and we really invest in it, I mean, you can transform generations through that process. And to me, I get fired up about that. I think that's a huge deal, and it really matters. And folks, thanks for listening again today, and have a successful deal process. And we'll talk to you next time.
Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.